Hello, good evening. Welcome back to Money Mondays, a permanent feature on Dentistry Invest where we talk about money every single Monday, exactly what it says on the tin. And we're here to talk about something interesting to everybody because it is a topic that is often misconstrued and misunderstood, and that is the topic of risk. Let us go ahead and jump straight into the webinar. Here we go. Risk and Invest in Money Mondays on Dentistry Invest. This is super interesting because this is going to unravel some of the reasons why people get misconceptions about the word risk and how, if we invest correctly, you can actually make risk your friend. And risk sometimes is your friend because it's associated with higher returns, but you must know how to use it properly and maturely. Not financial advice, of course, as we all know. Let's go ahead and jump straight in. So let's break this down into its parts. Let's get logical. There's actually four main types of risk. Now, for anybody who says, "Oh, but I'm not doing this, it's too risky," we need to go deeper than that. There's actually different types, and depending on how we invest, we can actually mitigate all of those types if we look to the long term and if we know what we're doing. But in order to do that, we must understand the different types. Here are the four main types. The first one is platform risk, the second one is systemic risk, the third one is specific risk, and the fourth one is market risk. So what the heck are those? So platform risk. All platforms in the UK are insured up to £85,000. All platforms that deal in regulated assets, and that includes bank accounts and also ISAs and also any investing account. However, this is backed by the Financial Services Compensation Scheme. However, that only, as we said earlier, it only applies up to £85,000 and it's only once per platform. So if you have £85,000 in one platform, you can't get any more than that returned to you should the platform go bust, because that's what platform risk is. It's the exchange via which you're investing. It's the risk that they might go under, they might cease to be a company whilst your funds are in there. But we've got to be really careful about this because platform risk can be mitigated by choosing platforms which are big and reputable as possible. Also, as well as that, the more money that you have in one account, the more it can compound. So splitting your assets across many different accounts will mean that you'll only ever max out 85,000 in each one, and therefore compounding can't work for you as best as possible. So we have to accept this to a degree. The way we can mitigate this is by finding big platforms that are significant. There's no significant risk of them going under anytime soon. And for anybody who wants a podcast on this specific topic, think about which ISA provider you should choose. Choose one of the bigger ones. You can use this Dentistry Invest podcast episode, Dentistry Invest podcast episode number 49. Which ISA platform should I choose? It will help you massively because an ISA should be the mainstay of virtually everybody's investing who is UK based. So systematic risk. Here's the thing. What is the chances that an asteroid might strike the world tomorrow and all life cease to exist, or at least most life does, or the odds of an atomic war, or even a significant war, a big war, a conventional one, meaning that all assets tank? Systematic risk is possible. Basically, if systematic risk occurs, if something that leads to a systematic risk to a platform occurs, then we likely have bigger fish to fry at that point. In that it might mean the collapse of society as we know it, in that it might mean the destruction of civilization. At that point, our stocks and shares portfolio is not going to be high on our list of priorities. So we can't sit around just waiting for this to happen. And who's to say if it does happen, even if it does happen, that all the cash that we hold so near and dear might be worthless as well because the governments might become defunct. This is where the gold bugs argue that holding some physical gold, hiding it in your house under a mattress, is a way to mitigate this. However, really, in reality, the odds of this happening are so unbelievably slim that it means that it's not something that we should be sitting around and waiting for, because that would mean that it is hugely detrimental to our odds of generating long-term meaningful wealth, which will allow us to become financially free. So systematic risk, we can never fully get rid of this risk. Definitely one of the ways we can mitigate it is that we think about maybe having some gold in our portfolio. That will not be necessary. Not everybody will have that point of view. Some people think that this is such a low risk that it's not even really worth thinking about. And as I say, there's nothing really you can do to change this anyway. So why let it detract from your possibility of generating financial freedom? Specific risk. Now, this is an interesting one. Let's say I buy one company. I actually have made quite a risky move there. If I buy one company and allocate all of my portfolio to it, and the reason is I have placed way too much of my faith in one company, no matter how big it is, no matter how amazing it is, and that would mean that I am in no way mitigating my specific risk. Specific risk means that if you're invested all in one place, your portfolio is only as good as that company is. Now, what if that company does well? Then that's all well and good. But the thing about it is, really, if you're investing with a long-term perspective, it's going to mean that you have to have that one company for 30 years and it has to continuously do well. A lot pretty hair raising is that. So really, to mitigate specific risk, we need to think about diversifying. We need to think about spreading our wealth across many companies, many big companies, maybe blue chip companies. Then at that point, that gets more into your strategy. All we're talking about for the moment is mitigating this risk. And to do this, we need to diversify, whether that be via funds or whether that be creating our own bespoke portfolio. That is entirely up to the user. I can't go any more specific in that for the moment, but this risk is what you're exposing yourself to if you have a portfolio all in one company. And the number of times I see that all in one company or all in one crypto, absolutely bananas, especially given what happened to Luna the other day. You really can't and shouldn't do that because there is a good chance that you may end up broke unless you spread your wealth. Now then, market risk. This is the risk that the market will go up and down over a set period of time. We can't do a terribly great deal about this, but what we can do is invest with a long-term perspective. If you buy the S&P 500, if you buy the MSCI, a fund which is its allocation matches that index, then what that will mean is that you are suitably diversified throughout the whole market. In the short term, that might mean that there's volatility and fluctuations. I wouldn't do that if I was seeking to have that cash in anything under 5 years. Realistically, 3 to 5 years, some say 5 years to maximize your chances. The reason is the market has never declined over a 5-year period if you buy the right assets. You must know what you're doing though. You must understand what you're buying in order to mitigate this risk. And also, as well as that, you must understand your time frame before you purchase something, because market risk is the main reason that volatility occurs in the market. Now, if you have sought to diversify yourself sufficiently, what that will mean is that the market is not going to be an issue for you because you will be looking to the long term to withdraw your profits. Therefore, we know market risk can be mitigated by understanding time frame over which we're investing and not investing our tax money or something that we need very short term. That will mean that you're significantly exposed to market risk. So you can see basically every single one of these risks, if you know what you're doing, you can almost entirely diminish them to the point where they are not significant in your investing. It all depends on your strategy and style. So next time you say something is risky, really break down why it is risky and understand whether or not you can actually remove that risk based on your strategy. The key, of course, however, is to identify what these assets are. What are the big assets that only go from bottom left to top right? Which ones should you purchase? That comes about through a knowledge of investing itself and looking to the long term. It's really simple if you look to the long term and you know what you're going to buy as well. So the key to this is to identify which assets generally tend to go up over long periods of time and hang on like a white knuckle roller coaster ride when there's that volatility in the short term. And if you can wait that out, then history will have proven that on certain things you can only ever win. But of course, you have to do your own financial research, conduct your own deep dives into information so that you know what to do. And then what that will mean is that you're protected because you've educated yourself. It's not just the only thing you have to look out for. You need to ensure that if you are going to buy these things, over what time frame you're going to, whether or not you want to allocate a certain part of your portfolio to equities and a certain part to bonds. There's a few more layers of decision than what I have just mentioned. Um, however, like I say, this can be diminished to very close to zero if you know what you're doing. So just educate yourself on risk. This was mind blowing the first time someone showed this to me. Okay, so what happens to our list of risk? Our list of risk, that is a tongue twister. Platform risk. You must pick a platform if you're going to invest. You can either not invest, bad idea, or find a reputable platform. That's the way you can remove that. Systematic risk. You have bigger fish to fry if any one of these happen. If a flipping asteroid hits the Earth, you're not going to be really too worried about your ISA balance. So barring a total catastrophe that wipes out the planet, you don't really have to really worry about this when it comes from the point of view of your perspective when you're investing. Specific risk can be reduced to virtually zero if you sufficiently diversify. What if you just buy things that mirror the world's economy? What if you buy things that perfectly represent the whole economy of the world? What that will mean for you is that, guess what? You don't have to worry about specific risk because you're not over leveraged in one company. And the number of times I see people with one stock or one company as their whole portfolio, crazy. And market risk, it's inevitable they're going to go up and down. If it was easy to invest, everyone would do it. Okay, they're going to go up and down. It's going to happen. Buy the correct things and zoom out. So we can conclude from our analysis, risk is part of the game, but it can almost be entirely mitigated. Remember what is guaranteed: inflation, because of money printing, which is essential to our economies. That will always hold true. There'll always be more money printed. There's heavy incentives for governments to do that, which will mean that there'll always be inflation. This erodes the value of our cash constantly without ceasing. Therefore, doing nothing is not an option. You must educate yourself on this stuff to create financial freedom further down the line. See you next week at the next Money Monday. Thank you so much for listening.